All right, well, good afternoon, everyone. Thank you for taking the time to sign in today's webinar. And Brian Cochran here. I'm beside John Moore. We're both here in our Albuquerque office today. And again, thank you for taking the time to participate. A few quick housekeeping items. First off, you're all on mute. If you have any questions throughout the presentation, feel free to use that control menu you have on the right side of your screen. And there's a chat or questions tab there that you can type in your questions, and we'll address those towards the end of the presentation today. Also, if you have any more personal or individual questions, you can always feel free to reach out to us, give us a call here at the office, and we'll follow up with you in a timely manner. So, also, just to be aware, today's presentation will be recorded. So if you missed the last 5-10 minutes because you have to sign off and go do other things, that's fine. In a week or two, we'll have this up on our website. If you go to johnmoore.com, look at the top right of the homepage, you'll see a tab called Media, and there's a drop down there for this webinar, and past webinars will be there. There's lots of great content there. We encourage you to go there periodically and see what we posted. So with that, I will turn it over to John to kick us off and give us a little update on what's been going on here at John Moore Associates.
Thanks, Brian, and good afternoon to everyone. I just wanted to give you a quick update. We continue to maintain both offices here in New Mexico and in Arizona. We recently extended the lease on both offices, and we were very excited about the growth and opportunity in the new market in Arizona. We have 2 people now full-time there, and it's designed to serve your friends and family who might live there and would like a personal touch from a local availability. One of the things that we've discussed now for several years is our 3-generation continuity plan, and Connie and I represent the G1, the first generation of the group here. And recently, G2, we added Joe Lemke. Joe joined us from Walgreens. He was 31 years at Walgreens, and we're very excited about having Joe as part of the JMA team. Our G3, Erica, Andrew, and Brian, those are the age 30 plus or minus folks, continue to function very well, and we're very excited about the ability to serve multiple generations of families with multiple generations of advisors. Recently it was announced that we are a recipient of the New Mexico Ethics and Business Award. That's sponsored by the Samaritan Counseling Center and involved a screening process that included students from the UNM School of Business, the Anderson School at UNM. And that award will be on April 26th, and we're very thankful and blessed to have received that award in the for-profit category. Brian?
As we get into today's content, we're going to start with the topic of the day, most certainly, which is politics. It's on everyone's mind. It's certainly on most of the headlines you see today, and it's impacting the financial decisions that the families we serve make every day. So we wanted to make sure we address that as part of today's content, and really the focus, at least for the first half of this presentation. And what's really changed since the election is we've seen a mix of different signs of optimism. And to start with, I'd like to point at this chart, which is an index, a survey really of small business owners. And you can see the sudden increase after the election in this chart, and optimism hitting recent highs. So this definitely says that business owners are optimistic about economic prosperity being in the near future. Secondly, we look at investors and what are the expectations for stock market returns going forward, and we're seeing recent highs also in the expectations that stocks would be higher in the next 12 months, which is what you can see on this chart. This can sometimes be a bit of a contrarian indicator. Basically, when investors are overly optimistic, maybe it's a sign that the market's a little ahead of itself. And we'll talk about that in a minute here as far as our perspective as to where the market is relative to fair value. But another sign that overall there's a high level of optimism. A third place we see it is in consumer sentiment. So basically, how are consumers feeling about the economy? And right now, we're hitting, again, recent highs, coming off of very low periods during the recession. You can see all the various recessions going back several decades in this chart, going all the way back to the 60s. And we've recovered slightly above the long-term average here. Again, maybe another contrarian sign, and we'll talk a little bit about retail sales in a minute here, but the hope is this new high, recent high in consumer sentiment will lead to more spending and more economic stimulus as people are out buying goods. When this number started to go up, and we saw this article recently in Yahoo Finance, this was about a month ago this came out, about consumer confidence being at a 13-year high. John actually shared this article with me, and one thing he pointed out that I think is rather fascinating is if you look deeper into the numbers, we see that overall consumer confidence is very high. But as you dig deeper again, you see that there's a big disparity. So among Democrats, the expectation is very low, at about a number of 55, which basically says that they think a recession's around the corner. You look at Republicans, and that same index is at 122, so just a massive disparity based on political affiliation. So this is not uncommon to see at some level, but these levels are very high as far as that big disparity between different groups. And I would say that we've seen this a lot in our conversations with families. As they come into the office, we hear maybe a lot of anxiety for those who lean one way politically and a lot of optimism for those who lean the other side. So we just think it's rather fascinating to see that type of disparity. What we really see is basically where you get your information is going to dictate your political opinion, but also your financial opinion and how optimistic you are about the future. And I love this quote. I pulled this out of a book I've been reading through recently about people often work hard to obtain information they already have and avoid new knowledge. And in the industry, we call this confirmation bias. And with the way the media is nowadays, it's very easy to succumb to confirmation bias, which basically says that you go out and you will look for information that supports your current feeling, your current theory, or your philosophy about how life works. So what I encourage you to do is you're out reading and when you're watching TV, you're listening to the radio, always go out and seek a source of information that's contrary to your own personal bias and beliefs. And that's something we do in the information we read. So if I read an article that might support our optimistic view on stocks and earnings, I'll also go out and look for something that's contrary to that and try to find a balanced approach between the two. And this is so important just as you try to make a good balanced decision-making process for yourself on your day-to-day decisions. And our role as advisors is we're allowed to have political opinions, and I guarantee you we do have strong political opinions and affiliations of our own. But we do a very good job, I think, of pulling ourselves out of that and looking at hard data and trying to always look for opinions and information that contradicts our natural inclinations. So I encourage you to do the same when you're out there reading and taking in information.
Well, there's a saying in the business that the trend is your friend. So we do spend time looking at trends as a way to help us understand where the markets are relative to their historical norms. And one of the things that we like to do here is look at the returns both recently and longer term. And there's two things I'd like to point out here. Number one, this year the S&P through the end of March was up about 6%, and the EAFE, which is about 2/3 Europe and 1/3 Japan, is actually outperforming. Now on the 10-year basis, the EAFE has been underperforming significantly. So in some of the portfolios that you own, we have placed an overweight position in an exchange-traded fund that represents that EAFE index. Our idea and our thinking is that it's about time and maybe overdue for the EAFE to play catch-up, because historically the returns there have been pretty similar to the returns in U.S. markets. The other thing that we've shown this slide every time we meet, and the message of this slide is that investors pay for earnings. Sometimes they pay too much for earnings. This is a bubble right here where the S&P in black is way ahead of the earnings line there in that orange color, and that's paying too much. That was valuation bubble. But since then, the markets have tracked the earnings line very faithfully. And what you'll see up here in the top right is that right now, based on projected earnings, we might even be a little ahead of trend. One of the things that investors are considering is the idea that there may be tax reform, particularly for corporations. And if that tax reform comes into shape the way that people are talking, it could result in as much as a 20% increase in these projected earnings. And some of that tax reform is probably priced into the market. So it wouldn't surprise us to see a pullback. In fact, if you look at the last 4 weeks prior to Monday, 3 out of those 4 weeks were negative, maybe we are in the middle of a correction right now. Time will tell. Many of you have seen this chart before also, and what we did over here on the left-hand side is we looked at the 20-year period from 1975 to 1994, and we declared that period normal. Now, normal does not mean no volatility. In fact, the crash of '87 is right there. That was a 22% down day. And we asked the computer to tell us what was the return for that period, that 20-year period, and the return was about 8% a year plus dividends, and that yellow line represents that 8% trend. Well, we got ahead of the trend in the late 90s, just like we were in that bubble in the previous chart. We were below the trend for a while in the early 2000s, and in 2008 we literally fell out of bed, and it became mathematically impossible to return to that yellow trend line. So in the summer of 2009, our quantitative consultant, Virgil Dugan, proposed that we have a reset, and that reset is represented by the magenta line here. And the one thing that was very important that Virgil said is don't change the trend line. The 8.1% is the right trend, but just start it from the reset point. So the bold magenta line represents that 8.1 trend. And again, you can see in the top right that we're slightly ahead of that trend at this point in time, right there. Other trends, again, just to kind of show you that we're ahead of, one is the S&P with dividends reinvested. The other one is just straight price appreciation. And again, you can see right there in the far right-hand side that we're slightly above trend. So a correction wouldn't surprise us. And when it comes to corrections, we do a lot of time looking at stock market history. We think there's some valuable lessons there. And volatility corrections are normal. In fact, it's that volatility that helps contribute to the extra return available from the stock markets. And historically, what we've seen is a 5% loss 3 times a year, one of those turning into a 10% loss once a year, and then every couple of years we have a 15% loss, and then every 3 to 4 years we have what's called a true bear market, which is a 20% loss. So the way we like to think about this is a 10 to 15% correction every 12 to 18 months is normal, it's to be expected, and we never know ahead of time what's going to trigger it. It might be the situation in Korea right now. It might be what's going on in Great Britain and France and Europe. We just don't know, but we don't want to be surprised from it, and we also don't want to let it distract from our long-term plan and our long-term strategy.
And to piggyback on what John was talking about, not knowing the future, just this morning I was on Twitter, and one of my favorite financial contributors, he's not affiliated with Raymond James, he's a contributor to the Wall Street Journal. He has a book where he has various definitions that can be quite entertaining but also very accurate. And he has a definition for certainty. And he said, certainty is an imaginary state of clarity and predictability in economic and geopolitical affairs that all investors say is indispensable, even though it doesn't exist, never has, and never will. So if you're hoping for certainty from us when we make statements about the markets, it's not going to happen because there is uncertainty in the markets. And we like to remind you that the reason you get a premium return, a better return in stocks long term, is because of that uncertainty. And if you can tolerate that in the short term, we think the long-term outcomes are worthwhile. So,
and I have a friend that likes to say the only certainty is uncertainty. So that's another way to think of it.
Absolutely. So as John mentioned, earnings are expected to grow quite a bit this year, and it's really on the back of good economic momentum. And I want to focus just on a few key points of that today. The first is that retail sales as a whole are up pretty strong year over year. And we continue to see that trend that's been in place since the bottom of the recent recession. So you can see that we're up, it's about 3.5% to 4% trend over the last couple of years in retail sales. There's been some negative news just this week about some lackluster sales, but you'll see on this chart there are bumps along the road there where maybe sales shrink for a short period. But overall, we think that trend is very strongly in place. One thing that's confusing about that is I'm telling you retail sales are up, but if you look at the newspaper and it's talking about Kohl's is closing stores and Macy's is closing stores and Payless Shoes is going out of business and Sears needs to be put out of its misery. So you hear about these brick and mortar retailers going out of business, and we've talked about this in the past, but I think it's worth reiterating. it's basically a changing trend in the way consumers shop. And what you can see on this chart is there's various categories of spending. And the one that really stands out here is in the bottom right, department stores, down about 5, almost 6% year over year, while non-store retailers, which is basically internet sales such as Amazon, are up 13% year over year and on a very strong and steady uptrend. So what we're seeing here is just a shift again in the consumer. And just this morning there was an article I was reading about how this is costing a lot of jobs as these department stores close. But at the same time, Amazon is committed to hiring not only tens of thousands, but possibly hundreds of thousands of employees. So again, shifting consumer styles, shifting employment opportunities as well. One category that's had a little blip, if you look at the very top line there, would be motor vehicles and parts. After several years of a very strong trend, we had a little dip in auto sales recently, which again is not a surprise considering how strong they've been the last couple of years. So I always love this chart. It makes sense when I look at the way I shop, and maybe you're starting to move this direction too, where you just are looking at things differently.
And I've noticed that Amazon is using the Postal Service, and there's other opportunities for jobs, not just at Amazon, that's created by this trend.
So, absolutely. And many of you may have seen this, but Amazon put in a patent request for a blimp service where they have a giant blimp that would float above your city and then actually use drones to drop deliveries down from the blimp. So this is an area of a lot of innovation. We don't know what this is going to look like in 5 years, but pretty soon your packages might be dropped on your head on your way to work. So
yeah, and over in the Phoenix office, we needed some technology to fix a problem, and they brought it to the office in less than an hour. Just amazing change.
Yeah, who knows where this is leading. Yeah. So part of the reason why retail sales are up is because employment growth has been very strong. People need to be employed and have good employment to be able to supplement this type of retail growth. So what we're seeing right now is that job openings are at record highs, which is a sign that we're at or near full employment. And this has a lot of implications, but what we're seeing on this chart is there's about 5.5 to 6 million job openings in the country right now, which is a staggering number. And basically, if you are a qualified employee who wants to work, there's opportunity out there. Sometimes we have trouble aligning the education with the right, and the skill sets with the right kinds of job openings, and we're working on that as a country. But overall, it's a very strong message about where we are economically compared to where you can see in the recession, where there's only maybe 2 million jobs available in the country.
And in fact, one of the other numbers I've been seeing is the quit rate, and the quit rate is reaching new highs or recent highs. So if people are willing to quit their job, that means they're optimistic about finding a new one.
Yeah, that's quite a statement on the job market. And that leads us into a key topic today that we want to kind of keep an eye on over the next few years, which is interest rates and what's changing in the interest rate environment. And the reason why the employment transitions to interest rates is the Federal Reserve, who dictates the short-term interest rate environment, really has a dual mandate. The Federal Reserve manipulates interest rates in the short term really to do two things. The idea is to keep inflation reasonable, which is about 2% a year inflation, and to keep the whole country at full employment. So full employment, we think, has been met. The expectations have been met, and you can see there's two measures of employment at the top of this chart. The first is the U3 unemployment, which is what you see when you look at headlines about employment rate. It comes out monthly, and we're at about 4.5%, which again is considered full employment. The U6 rate is maybe more of an accurate representation of unemployment rate, and it's about 9%, but very far off of those highs we saw where it was closer to 18% during the depths of the recession. So again, from the Federal Reserve's point of view, that's mission accomplished. We are at or near full employment at this point. On the bottom, you can see inflation numbers of about 2%. So again, the Federal Reserve is at a very comfortable place right now where interest rates are probably set to rise steadily over the next couple of years unless one of these two factors changes dramatically.
We've had a lot of questions about, well, the Fed's raising rates, isn't that bad for the stock market? So this is a historical look back to the early 80s at Fed funds rate in the orange color and the S&P in black. And what you can see, we've highlighted each of the initial rate increases along the way here. And if you look straight up from those circled spots, you'll notice that there might have been a little bobble in the stock market, but once the rate started up, the market actually rallied. And if you think about it logically, if the Fed is raising rates, that means the economy is doing well or doing better. And if the economy is doing better, the stock market ought to be also performing better. And that is actually borne true this time around. Over on the right-hand side of this chart, here's the initial increase in 2015, and you see the market acting very strongly. So time will tell with this. We're actually more concerned about the last rate increase than we are about the first one. And again, we won't know that it's the last one until after the fact, but once the Fed starts cutting rates, that tends to be a signal the economy is slowing. And again, that would be a concern for the stock market. The other thing that goes, the Fed is a short-term rate. That's the one rate the Fed can control. The rest of the bond market is controlled by market forces, and it is a global bond market. In this chart, the top is the U.S. 10-year Treasury. The black line on the bottom is the German Bund. That's the government bond 10-year maturity in Germany. And because it's a global market and the German Bund is still around 0.3, where the U.S. bonds are around 2.3, if someone's shopping for a high-quality government bond to make an investment, that extra 2% might be enough incentive for them to put the money in U.S. bonds rather than in German bonds. And we think that's because of this global competition, that's going to tend to put a cap on U.S. rates. And that 10-year rate is important because it's what set mortgage rates and that sort of thing. And I think Brian's had some experience in the recent housing market that might bear that out. So.
Yeah, and I think what you see is the housing market here locally has tightened, and I think around the country you're seeing that, and it might be a response to this change in interest rates. And I think anyone who is on the fence about buying has experienced this jump in the mortgage rate along with the 10-year rate that you see in front of you now, and that's causing buyers to kind of get off the fence and start to act, and we're seeing very tight inventories in different parts of the country as compared to the last several years. So in summary, big picture, the takeaways from today that we really want you to take back with you, educate your friends and neighbors with, is first off, avoid the political distractions. It's not that politics aren't important, but we don't want politics to cause you to make poor financial decisions because of short-term implications. The second is that earnings drive stock prices, and earnings are expected to grow significantly over the next year or two, and that's what's driving the market higher overall. Third, volatility is normal. We expect corrections, and John made a good case for 5 to 10% on a regular basis is very reasonable markets. We shouldn't panic when that happens, even if the media tells us to. And last, the higher interest rates we're seeing are a sign of a good economy, and it's what we want, and it's a good thing for savers, so we don't need to be too pessimistic because rates are on the move. So overall, that's the big theme right now. There's no need to change course if you have a good, solid financial plan and a very intentional investment allocation and process. We like the trends we're seeing right now.
And I would reinforce that. And we would like to say thank you for joining us today. If you'll give us just a minute, we'll double check and see if there are any questions. And
if you want to punch in a question, feel free to go into the control panel on the right side of your screen. You should be able to open up a field that says question. There's another that says chat. We'll be looking at both. If you have any short-term market questions, we'll go there and address those for you now. Looks like nothing immediately. So, all right, well, we'll close for today. Keep an eye out for the next invitation for our next quarterly webinar. In the meantime, you'll also be seeing our regular quarterly newsletter with other timely topics that we hope you enjoy. And thank you for signing in today. We appreciate it.
Have a great evening.